Spoke to other global experts on what's happening in the global markets. Let's listen into their views.
Investors are really looking for at the moment is not $1 trillion or $2 trillion, but you've got to go big. You've got to go big, and if you look at, say, for example, the US's response, $1 trillion is a very, very small percentage of US GDP. You take the UK's example last week, they went with 15% of GDP, and yet we are still struggling to restore confidence to investors. Markets are still looking very, very weak, and the problem is we're getting significant downgrades to GDP for Q1, Q2, and potentially Q3 or Q4. It's very, very difficult to price this. And combined with a dollar squeeze, markets and investors are just piling into the safest asset out there.
We're very much flying blind at this stage. We don't have any indication. Today's unemployment numbers might be the beginning of something much worse, but we don't have much reliable data so far, apart from the Chinese data that came out, to almost guess how bad this is going to be. The good thing is this is a global thing, and the actions taken globally don't make one country jump out versus the other. I mean, everyone recognizes this as a global issue. Public debt is going to go up globally. The good news about this crisis, contrary to the others, is we know that it will end. It will end when there's a vaccine, when there's a medicine, but this will end. The question is how much collateral damage will be done at the moment that it ends. And I think that is what the governments at this stage already proactively try to avoid, is to contain the collateral damage to specific sectors, industries, that then seeps down into the banking system and causes it to be a very systemic risk.